There's a reason wealthy families stay wealthy, and it's not just because they have more money. It's because they know things you don't. Strategies, loopholes, legal ways to build and protect wealth that nobody teaches in school. Nobody shares at the water cooler. Nobody posts on Instagram. These aren't illegal. They're not shady. They're literally written into the tax code. But here's the thing. If you didn't grow up with wealthy parents or have a high-end financial advisor, you probably have never heard of any of them. Until now. Today I'm sharing 7 actual money loopholes that wealthy people use all the time. Every single one of them is 100% legal, and every single one of them is available to you. You just need to know they exist. Quick disclaimer before we dive in. I'm not a financial advisor or CPA. These are educational strategies. Before implementing any of them, talk to a qualified professional who can look at your specific situation. Now let's get into it. Loophole number 1, the backdoor Roth IRA. Let me explain what a Roth IRA is first, because if you don't understand this, the loophole won't make sense. A Roth IRA is a retirement account where you contribute money you've already paid taxes on, but then it grows completely tax-free, and when you retire and withdraw it, you pay 0 taxes. Nothing. The government takes nothing. Now here's the catch. The IRS says if you make over a certain amount of money, you can't contribute to a Roth IRA. For 2024, if you're single and make over $161,000, you're locked out. The government basically says, sorry, you make too much. This tax-free growth isn't for you. But here's what nobody tells you. There's a completely legal way around this, and wealthy people use it all the time. It's called the backdoor Roth, and here's exactly how it works. Step 1. You open a traditional IRA. There's no income limit for opening a traditional IRA and putting money in. Anyone can do it. Step 2. You contribute to that traditional IRA. The current limit is $7,000 per year, or $8,000 if you're over 50. Step 3, and this is the loophole, you immediately convert that traditional IRA into a Roth IRA, literally the next day, maybe even the same day depending on your brokerage. When you do this, you pay taxes on any gains, but if you convert immediately, there are no gains. The money hasn't had time to grow, so you pay almost nothing in taxes. Now you have Roth money even though your income should have disqualified you. Let me show you the math. Let's say you do this every year, contributing $7,000. Over 30 years at a 10% average return, that grows to $1.2 million. When you retire and withdraw that money, you pay 0 taxes. If you had that same money in a regular taxable account, you'd owe over $200,000 in capital gains taxes. Gone. Just by knowing this one loophole. This is explicitly allowed by the IRS. It's not a grey area, it's legal. Why don't you know about this? Because banks don't advertise it. Financial advisors sometimes charge hundreds of dollars to set it up, and it requires 2 steps instead of 1, so most people just never do it. Loophole number 2, the infinite banking strategy. This one is controversial, and I'm going to be straight with you about the pros and cons. But wealthy families have used this for generations, and there's a reason for that. Here's the concept in simple terms. Instead of borrowing money from a bank and paying them interest, you borrow from yourself and pay yourself back. How does this actually work? You start by buying a specific type of whole life insurance policy. Not term life, which is cheap and just covers you for a set period. Whole life, which is more expensive but builds cash value over time. Now the key is you overfund this policy, you pay more into it than the minimum required. Over years, this builds up a cash value. Think of it like a savings account that grows inside your insurance policy. Here's where it gets interesting. When you need money, say you want to buy a car, and instead of getting a car loan at 7% interest, you borrow against your policy. The insurance company gives you a loan using your cash value as collateral. But here's the magic. Your full cash value keeps earning interest even while you have the loan. So if you're paying 4% on the loan but your cash value is earning 5% on the full amount, your net cost is basically 1%. Compare that to a 7% car loan or 20% credit card. You pay the loan back over time, or you don't. If you don't pay it back, it just deducts from your death benefit. But either way, you're essentially being your own bank. Let me give you real numbers. Say you put $500 a month into a properly structured policy for 10 years. That's $60,000 contributed. Because of how these policies work, your cash value might be around $70,000 after 10 years growing tax deferred. Now you need $30,000 for a car. You borrow it from your policy at 4%, but your $70,000 keeps earning 5% on the full amount. You're earning on 70 while only owing on 30. The net cost is way cheaper than any bank loan. Now here's the honest truth about this strategy. It takes 7 to 10 years to build up meaningful cash value. The first few years, a lot of your premium goes to insurance costs, not cash value. This is a long-term play, not a quick fix. Dave Ramsey and most mainstream finance people hate whole life insurance. And for many people, buying term insurance and investing the difference is the right move. But wealthy families have used this strategy for generations because once it's built up, it's incredibly powerful. Why don't you know about this? Because it requires patience. It requires understanding how insurance works, and most insurance salespeople don't explain it properly. The rich do this quietly. Everyone else never hears about it. Loophole number 3, qualified small business stock, also called QSBS. This one is insane when you understand it, and it's how a lot of tech employees and startup founders avoid massive tax bills. Here's the setup. Normally when you sell stock for a profit, you pay capital gains tax. If you bought stock for $50,000 and sold it for $5 million, you made a profit of $4,950,000. The government wants 20% of that. That's almost $1 million in taxes. But there's a section of the tax code, section 1202, that says if you meet certain requirements, you can exclude up to $10 million in gains from taxes completely. 0%. Nothing. Let me say that again. Up to $10 million in profit, tax-free. Here are the requirements. The stock has to be from a C corporation, not an LLC or S corp. The company has to have had less than $50 million in assets at the time the stock was issued to you. You have to hold the stock for at least 5 years, and the company has to be an active business, not a holding company or something in real estate or finance. If all of that is true, and you sell that stock, the first $10 million in gains is completely tax-free. This is how early employees at startups that blow up avoid paying millions in taxes. They got stock when the company was small, held it for 5 years, and when the company went public or got acquired, they paid 0 on the first $10 million in gains. How can you use this? Work at an early stage startup and negotiate for equity. Start your own C corporation business. Angel invest in qualified small businesses, and most importantly, hold for at least 5 years. The math is ridiculous. Buy in at $50,000, sell at $5 million. Normally you'd owe almost $1 million in taxes. With QSBS, you owe 0. Why don't you know about this? Because it only applies to certain situations. CPAs charge real money to set it up properly, and it requires patience and understanding of business structure. But now you know. Loophole number 4, the 1031 exchange. This is how real estate investors build empires without ever paying capital gains taxes. And yes, it's completely legal. Let me explain the problem first. You buy a rental property for $200,000. Over 10 years, it appreciates to $500,000. You want to sell and buy a bigger property. But when you sell, the government says you made $300,000 in profit, and they want their cut. At 20%, that's $60,000 in taxes. But with a 1031 exchange, you can defer that tax completely. Here's how it works. When you sell your investment property, instead of taking the money and paying taxes, you use a qualified intermediary, which is basically a third party that holds the funds, and you identify a new property to buy within 45 days. You then close on that new property within 180 days. If you do this properly, you pay 0 capital gains tax on the sale. The tax is deferred until you eventually sell without doing another exchange. But here's where it gets really powerful. You can keep doing this forever. Sell property 1, buy property 2, sell property 2, buy property 3. Each time you defer the taxes. And then the real magic happens. When you die, your heirs inherit the property at the current market value. This is called a stepped-up basis. All those deferred taxes, they disappear. Your heirs sell the property and owe taxes only on gains after they inherited it. Let me show you the numbers over a lifetime. Property 1. Buy for $200,000, sell for $500,000. Defer $60,000 in taxes. Property 2. Buy for $500,000, sell for $1.2 million. Defer $140,000 in taxes. Property 3. Buy for $1.2 million, sell for $2.5 million. Defer $260,000 in taxes. You die. Your kids inherit a $2.5 million property at current value. Total taxes owed on all those deferred gains, 0. You just legally pass down $2.5 million in real estate and $460,000 in tax savings to the next generation. Why don't you know about this? Because it requires owning investment real estate. You need a qualified intermediary, which costs $1,000 to $2,000. The deadlines are tight and specific, and real estate gurus charge thousands for courses that teach this. But it's all in section 1031 of the tax code, waiting for anyone who knows to look. Loophole number 5, donor-advised funds. This one sounds like it's about charity, but it's really about tax strategy, and wealthy people use it constantly. Here's the situation. Let's say you have a high-income year. Maybe you sold a business. Maybe you got a huge bonus. Maybe you cashed out stock options. You're going to owe a lot in taxes. Now, you could donate money to charity and get a tax deduction. But what if you're not sure which charity you want to support? Or you want to spread donations over many years? Enter the donor-advised fund. Here's how it works. You make a donation to a donor-advised fund, which is managed by a financial institution like Fidelity, Charitable, or Schwab Charitable. You get the full tax deduction immediately in the year you made the donation. But here's the twist. You don't have to give that money to an actual charity right away. It sits in the fund, it gets invested. It grows tax-free, and you decide over the next years, even decades, which charities to distribute it to and when. So, in your high-income year, you donate $100,000 to your donor-advised fund. You immediately get a tax deduction of $100,000. If you're in the 37% tax bracket, that saves you $37,000 in taxes that year. But the money doesn't go to a charity yet. It sits in your DAF invested. Over 10 years at 8%, it grows to $216,000. Now you have more than double the money to give to causes you care about, and you already got your tax break a decade ago. Why do wealthy people love this? Because they can time their tax deduction strategically. In a low-income year, you might not need the deduction. In a high-income year, it's worth a lot more. The DAF lets you get the deduction when it's most valuable, regardless of when you actually give to charity. The requirements are pretty straightforward. Most DAFs have a minimum initial contribution of $5,000 to $10,000. You have to eventually give the money to qualified charities, and you can't take the money back. It has to go to charity eventually. Why don't you know about this? Because it takes a meaningful amount to start. Financial advisors get fees for managing the DAF, and most people think of charity as writing a check, not as a strategic tax planning tool. Loophole number 6, the mega backdoor Roth. Remember the backdoor Roth from earlier? This is its much bigger, much more powerful sibling. Let me remind you of the limits. A regular Roth IRA lets you contribute $7,000 per year. Even with the backdoor strategy, you're capped at $7,000. But the mega backdoor Roth lets you put up to $69,000 per year into Roth accounts. That's nearly 10 times as much. Here's how it works, explained simply. The total contribution limit for all 401k contributions in 2024 is $69,000. This includes your regular contributions, your employer match, and something most people don't know about called after-tax contributions. Most people max out their normal 401k at $23,000 and stop there. But if your employer's plan allows it, you can contribute additional after-tax money on top of that, up to the $69,000 total limit. Now here's the loophole. If your plan also allows something called in-plan Roth conversions or in-service withdrawals, you can immediately convert those after-tax contributions into Roth. So, you contribute after-tax money, convert it to Roth, and now it grows tax-free forever. You just put $69,000 in 1 year into a Roth account, way more than the $7,000 limit. The math over time is staggering. Let's say you do this for 20 years, contributing $69,000 each year. That's $1.38 million in contributions. At a 10% average return, that grows to over $4.3 million, all tax-free in retirement. If that same money were in a regular taxable account, you'd owe over $800,000 in taxes on the gains, gone, just because you knew about this loophole. There are 2 catches. First, you need to make enough money to afford contributing $69,000 per year. That's obviously not possible for everyone. Second, and this is the big one, your employer's 401k plan has to specifically allow after-tax contributions and in-plan Roth conversions. Many don't. Here's exactly what to do. Call your HR department or 401k administrator. Ask these exact questions. Does our 401k plan allow after-tax contributions beyond the standard limit? Does our plan allow in-plan Roth conversions or in-service withdrawals? If the answer to both is yes, you can do the mega backdoor Roth. If not, ask if they can add these features. Some companies will if employees ask, "Why don't you know about this?" Because only about 25% of 401k plans allow this. Nobody tells you to ask HR, and it sounds complicated, even though it's not once you understand it. Loophole number 7, the S corporation election. This one is specifically for freelancers, consultants, and business owners, and it can save you tens of thousands of dollars per year. Let me explain the problem first. When you work for an employer, you split payroll taxes with them. You pay half, they pay the other half, totaling 15.3% for Social Security and Medicare. But when you're self-employed, you pay both halves yourself. That's 15.3% on every dollar of profit. It's called self-employment tax, and it's brutal. So if you make $150,000 as a freelancer or consultant, you owe almost $23,000 just in self-employment tax, on top of regular income tax. But here's the loophole. If you elect S corporation status for your business, you only pay that 15.3% tax on your salary, not on all your profits. Let me explain with an example. You're a freelance consultant making $150,000 a year. Currently, you're operating as a sole proprietor or single-member LLC. You owe 15.3% on all $150,000. That's $22,950 in self-employment tax. Now instead you elect S corporation status. You pay yourself a reasonable salary of $60,000 per year. This is key. It has to be reasonable for your type of work. You can't pay yourself minimum wage as a consultant. The remaining $90,000 comes out as a distribution. Distributions are not subject to self-employment tax. So now you pay 15.3% only on $60,000. That's $9,180 in self-employment tax. You just saved $13,770 in 1 year, every year. Over 10 years, that's $137,000 in tax savings. Now there are costs. You need to file a separate S-Corp tax return. You need to run payroll for yourself, even if it's just you. You'll probably need an accountant, which costs $2,000 to $5,000 per year. But if you're making $60,000 or more in business income, the savings far outweigh the costs. Why don't you know about this? Because CPAs charge to set it up and maintain it. The IRS doesn't exactly advertise this. And most freelancers never explore business structures beyond basic sole proprietorship. They just keep paying the full 15.3% forever. Alright, let's stack all of this up. Loophole 1, the backdoor Roth IRA, available to anyone earning too much for regular Roth contributions. Potential lifetime tax savings of over $200,000. Loophole 2, the infinite banking strategy available to anyone who can commit long-term. Potential interest savings of thousands per year once established. Loophole 3, QSBS, available to startup employees and founders. Potential tax savings of up to $2 million on $10 million in gains. Loophole 4, the 1031 exchange, available to real estate investors. Potential lifetime tax savings of hundreds of thousands to millions. Loophole 5, donor-advised funds, available to anyone donating at least $5,000. Potential tax savings of thousands per year in high-income years. Loophole 6, the mega backdoor Roth, available if your employer allows it. Potential lifetime tax savings of $800,000 or more. Loophole 7, S-Corp election, available to business owners making $60,000 or more. Potential savings of $10,000 to $30,000 per year. These aren't secrets because they are illegal. They're not hidden because they're shady. They're just not taught to regular people because there's no profit in teaching you. Wealthy families pass this knowledge down generation to generation. They have accountants and advisors who implement these strategies automatically. They grow up hearing about 1031 exchanges at the dinner table. You didn't grow up like that. Neither did I. But now you know. Here's what I want you to do. Don't try to implement all 7 at once. That's overwhelming. Pick the 1 or 2 that apply to your situation right now.